This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only. Now, here's Shane and Deanna.
Hi everyone. Hi Shane.
Hi Deanna.
So Shane, there's been a lot of volatility this week in markets. What's been driving it?
Look, I think there's a bunch of things. Firstly, there was concerns about maybe a recession starting to unfold in the US. We'll come back to that one. Secondly, shares have had a good run and valuations were somewhat stretched, so you could argue there was some vulnerability there in the first place. And then finally, it all tied together with the Bank of Japan raising interest rates. It seemed to be a non-event a week or so ago when they did that, but then it seemed to trigger many investors thinking, well, we better unwind the so-called carry trade, where you borrow at zero in Japan and invest maybe in the US or somewhere. So all of those things came together and we saw something like 9% or so top to bottom falls in US and global shares, a lot more in Japan. The Japanese share market at one stage fell 25% and we came down almost 6%. Obviously, still early days yet. There are those same risks out there regarding slower economic growth, recession and so on. And this could still go for a little bit further.
So it seems like it was a sort of a perfect storm of all these factors coming together because we've known about all these different issues for a while now. We've been talking about the risk that shares might be priced to perfection and that you might see a bit of a fall. And this is also going on at the same time that the US earnings season is happening, but earnings growth hasn't actually been too bad in the US.
It's actually been quite good. I guess the problem is that everyone expects it to be good or better than the last time. The last few times have been really, really good. This time's been good, maybe not as good. If you look at the stats, earnings are on track for something like 10% growth, nearly 80% of companies beating expectations. Where I think it was a bit more mixed, though, was in relation to tech, where companies might have outperformed, but the guidance wasn't as good, or they might have underperformed. So that was a bit more mixed. And that sort of contributed to volatility in tech stocks. But I think the real issue is the recession risk in the US, and that seemed to kick off, particularly after some jobs figures came out in the US. So what did you make of that?
So the July jobs data showed the unemployment rate increasing from 4.1 to 4.3% in the US, and it's now increased from its post-COVID low of 3.4%. So it has been quite a steep lift. And this rise in the unemployment rate now has triggered what economists call the Sahm Rule, which is basically a measure of the change in the unemployment rate relative to its cyclical low. And when it increases, usually by more than 0.5 of a percentage point, that has historically always lined up with a recession. If you do a basic chart on those two things, every time the unemployment rate has gone up by that much, you've always had a recession in the US since the late 1940s. So this is causing some concern that the US is already in a recession.
So it makes it look like it's a certainty, but it's surely not a certainty. I mean, for many years, I think we've all known that when unemployment goes up in the US, it often keeps going.
Yeah.
But these are weird times. We've had the pandemic, and that may have distorted the relationships.
I think that might be what's going on right now, because if you look at a broader range of labour market indicators, they've been weakening now for some months, and we've been speaking about those leading jobs indicators, the job openings rate. But the job openings rate relative to the number of people unemployed hasn't actually collapsed. It's just gone back to its pre-COVID normal levels. So I think you'd really need to see further falls in those and more increases in initial and continuing jobless claims for those people who are unemployed to actually be more convinced that the US labour market is actually collapsing. Then you've also got the problem that maybe the July data was impacted by the hurricane that's going on in the south of the US, especially in Florida. And that might be causing some disruption to the jobs data. We probably just need to see more evidence of a broader base weakening in the labour market, I think, to be convinced that the US is going into a recession.
Yeah, it seems like one of those tough ones to try and work out. I mean, my feeling is there is a very high risk of recession simply because central banks have tightened rates so much, and there's this old saying, it's okay till it's not. Things look okay and suddenly you find, whoops, we've left rates too high for too long, and then you go into recession. But this has been an odd cycle and has surprised many in different directions. So it could well be that central banks just managed to pull it off without a recession.
And there's also mixed economic data. So the other piece of economic news that investors didn't like was the manufacturing ISM in the US, which showed that activity is below that 50 index level, which means that manufacturing activity is contracting or negative. But if you look at the PMI version of that same indicator for manufacturing, it was actually much stronger, and services activity is still very strong. So mixed economic indicators after the pandemic. I don't think that it's a certainty that the US is in a recession right now.
So I guess the question in all of this is what it means for investors. And my take on it is, one, we were vulnerable to a correction. Secondly, it's perfectly normal to have these ups and downs. If the share market just went up in a straight line, we'd all be sipping champagne in the south of France. Well, I wouldn't be, but a lot of people dream of doing that, but I'd find another place to do that. It's never that easy. You get this volatility. I think the volatility is the price we as investors pay for the higher returns you get out of shares over the long term. But the key point is that corrections are normal. I think it's critically important for investors to realise that it is very hard to time markets. Yes, we could be going to a recession, maybe not. We do have uncertainty about US politics, but it could turn out to be relatively benign. There's lots of risks in the Middle East. So all of these things are out there. And yes, they could mean more weakness in shares to come, but trying to time that is going to be really, really hard. And I think the key for investors is to make the most of what we call compound interest, the magic of compound interest. To borrow from one of the economists who had a big influence on me, a guy called Dr. Don Stammer. And that is where people get their wealth from, taking advantage of the fact you get these higher returns out of growth assets over the long term than you'll ever get having your money sitting in the bank. And make sure you don't get blown off by the cycle, by this sort of volatility we're seeing. So yes, markets could well go lower. We could be in for a rougher patch. August and September are known to be rough. But I think the key for investors is try and stick to a long-term approach. Don't get blown off by these sorts of events and just realise that it's going to be very hard to time markets. You might get out for a few nights, sleep better at night, and then find markets taken off again and you've missed out on it. So it would have been better to just stick to your strategy.
So the Reserve Bank of Australia met this week, and the August meeting was a bit contentious because a few weeks ago, some people thought that we'd actually get a rate hike at this meeting. That was even partly priced in by financial markets, and a lot of prominent economists were out there talking about the need for higher rates. As it stands, the Reserve Bank left the cash rate on hold. What did you make of their statement and also their release of their new forecasts?
Look, it's certainly been a roller coaster. Money market expectations have gone from something like a 70% probability of a hike a few months ago. Money market was still pricing in probability of a hike just a week or two ago before the inflation numbers. So it was still that possibility there. And then suddenly we got the CPI numbers, not as bad as feared. And then, of course, we had this turmoil in markets. So the market went from thinking about possibility of hikes to suddenly thinking, well, maybe we'll be looking at cuts. In fact, the day of the RBA meeting in the morning, the market was thinking, well, possibly we'll get a cut as early as November. Then, of course, we've got the RBA decision, which I thought was sort of somewhat hawkish. It didn't seem to be, the RBA didn't seem too concerned about what's going on in relation to the US and markets. I can understand that to some degree. Markets do bounce around a lot. I think Paul Samuelson once said, he was a well-known economist, that share markets have predicted something like 6 of the last 2 recessions. So you've got to be wary of that, and therefore a central bank like the RBA is not going to get blown around. We'll want to avoid getting blown around by what markets do. But I was surprised that they didn't pay a lot of attention to it. I would have thought since the last meeting, the last time they revised their forecasts in May, you've got weakish data out of China, more uncertainty about the US. If you're looking in Australia, we got the weaker than expected March quarter GDP numbers. There's more evidence that wages growth looks to have peaked. The inflation numbers were no worse, roughly in line with expectations. So I would have thought they would have sounded a bit more balanced, but it turned out the RBA still sounded a bit more hawkish. They're still considering raising interest rates further, still worried about excess demand in the economy. That is, I guess a reference to Milton Friedman, too much money chasing too few goods and services. And when that happens, prices can go up. So they're still worried about those sorts of things. So I was a little bit surprised at their hawkishness. I don't think there's a case for another rate hike. But if you listen to the RBA, it looks like a rate cut is still at least 6 months away. And in the interim, there's still some risk of a hike.
So they revised up their inflation forecast, particularly for the trim mean and slightly for the trim mean. They revised the headline numbers down, but only because the cost of living measures from the government, which we knew about after the budget and after the state budgets as well in the past few months. But now they're expecting to reach the midpoint of their trim mean or that core inflation target about 6 months later than they previously thought. But they didn't hike rates. So does that mean that there's a high bar for a rate hike?
Well, it seems like there is. I think the RBA is conscious also that they've done a lot, and there's long and variable lags in the way monetary policy impacts the economy. So there's still weakness feeding through. So that seems to be in their mind saying, well, yes, we've got inflation which is now too high, but if we allow for the fact that monetary policy is already tight and there's weakness continuing to feed through, then we're best sitting where we are. But obviously there's a lot of debate around this. There seemed to have been a somewhat contentious RBA decision. I know the government's saying that things aren't as good as the RBA's thinking it is. I mean, the RBA seems to be partly implying, but not quite saying, that government spending is a bit of an issue because they revised up their government spending forecasts. And I tend to agree with that. There is a bit of an issue there. If government spending wasn't this strong, growing at 4% a year, the RBA probably would be thinking about cutting rates by now. So it's a fairly messy situation, but some things give me confidence. Inflation is falling globally. Other countries have gone through pauses, notably the US, in getting inflation down, and then inflation resumed on the downside. We have seen falling job openings, job vacancies in Australia, just like the US. That will probably lead to lower wages growth, hopefully not recession, but lower wages growth. So I think we're still heading towards the next move being a cut. It's just, given where the RBA is right now, to get a cut this side of Christmas probably requires some sort of shock, more bad news out of the US or a big fall in share markets. So looks like the most likely timing is early next year. So one of the big issues at present is whether we go into recession or not. If you look back historically, you tend to find that when share markets have relatively mild falls or corrections, or they might even have a 20% fall and then quickly recover, that there's those sorts of declines in markets, some of which I refer to as gummy bears. And then there's grizzly bears, where the share market falls 20%, like the GFC, and then a little while later it's down another 20% and then takes a while to recover. So that's a grizzly bear versus a gummy bear. And one of the big differences is whether you have a recession or not. Invariably, recessions lead to big slumps in earnings and then big bear markets, whereas if you avoid a recession, you only get a mild pullback or a mild bear market. So I guess the big question in all of this is, what do we mean by the term recession?
So basically a recession is when the economy goes backwards in terms of growth. The way we measure growth is through the GDP data. So when you have 2 consecutive quarters that have had negative growth, that's when economists classify a recession as having occurred. It is always important to look at the components within the GDP figures because you can get some one-off large moves, especially in Australia, for things like net export growth and inventories that can mean even a negative quarter of growth might not actually be as bad if the other components aren't as weak. In other countries, like in the US, they actually have a body that meets and discusses when the
It's
recession...
like a committee.
A committee called
recession dating committee.
called the NBER that looks at not just growth, but also other things like unemployment and wages to determine when the recession happened. Of course, by the time they meet, the recession's probably already occurred, so it's a little bit useless. And a lot of hindsight is obviously involved in that. The best thing, I guess, to look for when you're thinking about the risks of a recession are leading indicators. So most countries have a leading economic index. We have one that's designed by the Melbourne Institute. The US has one as well, which has actually been in recessionary-like territory now for a while. And I think also the yield curve has been a good guide to recessions in the past, particularly in the US.
Not so good in Australia, though. It's sort of...
Well, we haven't had as many recessions in the last 30 years to use it as a guide.
So one of the complicated things I've found is that Australia doesn't have a great track record in the last 30 years of recessions. Yes, we had the pandemic where we were all told to stay at home, so I don't think that really counts. To get a recession, you've got to go back to 1990-91. And this brings in this old term, the US catches cold, we get the flu, or the US sneezes and we get a cold. It doesn't always work that smoothly. It used to work really well up until the 1990s. All the recessions they had would inevitably see a recession here. And then after that, America had the tech wreck. We had a bit of a slowdown, not much. They had the GFC. We had a bit of a slowdown and not much, but not a recession.
Maybe because we were protected by the growing Chinese economy?
I think it's diversification. China, which actually did quite well through the GFC, or not as bad as the US did. And also our economy has become a lot more flexible. So you've got bits going down in tune with the US and other bits sort of doing okay. And I guess the other factor has been the floating Australian dollar. whenever the world goes into recession or the US goes into recession, the Aussie dollar goes down, our exports suddenly become a lot more competitive. What import competing businesses we have, they also become more competitive and our economy gets a boost. So maybe that was a factor as well. So just bear in mind that old saying is not as reliable as it used to be in relation to the economy, although it is reliable normally in relation to the share market. When their share market goes down, we tend to go down as well, particularly if it's a big move in the US. But I think in all of this, a couple of points to note. One is trying to forecast whether there's going to be a recession or not is always going to be a little bit difficult. Economists have crystal balls, but sometimes those crystal balls are a bit hazy. Secondly, if you want to make money, you grow your wealth over time, the best thing to do is make the most of compound interest. To do that, make sure you don't get blown off by cyclical swings in markets and try and invest for the long term. Bottom line in all of this is that trying to time markets is really, really hard. That's it for this week. All the best. See you, Diana.
See you, Shane.
For more info on Shane and Diana's podcasts and reports, head to the Insights Hub at amp.com.au.